Good evening, everybody. Thank you very much for joining us this evening for what I'm sure will be an interesting and stimulating talk. For those of you that don't know me, I'm Catriona Hyde. I'm a senior lecturer here in Accountancy, Finance and Economics at Lincoln International Business School, and I'm also a chartered accountant and, in case you haven't guessed, a former auditor. Before we begin, just a couple of housekeeping tips. The talk will be recorded, so you will be able to watch it back again. And if you want to ask questions, you are going to need to be logged in. So you can pop them in as the talk is going on, and I will ask them once our distinguished speaker has finished speaking. I now have great pleasure to introduce Dr. Craig Marsh, Pro-Vice Chancellor and Director of Lincoln International Business School, who will introduce our guest this evening. So Craig, over to you.
Thank you very much, Catriona, and a very good evening to everybody, and a very warm welcome to this guest lecture. And it's a source of great honour and pride, actually, that we have a distinguished speaker with us this evening. So it's my great pleasure to introduce Sir Jon Thompson. And Jon is currently, as sure as everybody's aware, the CEO of the Financial Reporting Council. But before that, he's had a distinguished career in the civil service, principally. He's been the CEO of HMRC, the UK Tax Authority, a very large business in its own right, employing more than 65,000 people, and of course was embarked in driving reform of the UK tax system. He's also been permanent secretary at the Ministry of Defence, which in itself is a £36 billion organisation, which he led with the Chief of Defence Staff at the time. And before that, he's had a lengthy finance career, including as a Director General of Finance at the MOD, Director General Corporate Services at the Department for Education, and Finance Director of Ofsted. Before joining the civil service in 2004, Jon held a number of corporate services and finance roles in the public and corporate sectors. And I know that Jon has also, and I'm very, very envious of the fact, as part of his role when he was at the MOD, managed to meet President Obama on Air Force One, which is fantastic. Probably even more impressive, had a flight in a Typhoon, Jon, I think, which has certainly been one of my ambitions to be able to replicate that. And Jon, I believe that I know it's great that you're in Lincoln with us, but your heart, I believe, lies slightly southeast of here as a Norwich City fan, which I think, given their current position in the Championship, is definitely something to be bragging about at the moment. So anyway, Jon, without further ado, thank you so much for joining us tonight. And Jon is going to be talking to us tonight about the changing landscape of the audit profession. So Jon, over to you.
Craig, thanks for that very generous introduction. So just to add a couple of things to what Craig said, I've also worked for Ernst & Young as an auditor, and I'm a double qualified accountant. So I think I know something broadly about the landscape here. So what I'm going to do is talk about the accounting and audit landscape and reform in 2021. And this is a reform program that will last for many, many years. So what I'm planning to do, he said, is to cover these 6 topics in around 20 to 25 minutes, and then take as many of your questions as we can in the time that we've got. So I think I need to start with some of the fundamentals, which is, well, if for those of you who don't know what the Financial Reporting Council does, well, what does it do? What's its purpose and scope and remit and so on? And that naturally leads on to what are the current accounting audit standards and the regulatory regime that applies to accountants and auditors here in the UK. So I'm just going to set out that sort of base level of where we are now. And then I'm going to try and go on to explain the 3 reasons that this landscape needs to change. One of those big drivers is the fact that this landscape has been reviewed 3 times now by various independent people. I'm going to run you through those 3 independent reviews that made 155 recommendations for change, a really huge number of recommendations before the government for change. I'm going to presume that change is actually coming, and I'll explain why. And then what impact does this actually make to the players in the audit and accounting landscape? That is, between investors and companies and audit firms and the regulator. Those are the 4 main parties involved here. And then say a bit about when you might see these changes and how you can engage with them. So to start with it then, just the basic level here, the purpose of the Financial Reporting Council, why do we exist? There it says it fairly clearly there, we're here to serve the public interest by setting high standards of corporate governance and reporting and audit, and by holding to account those parties responsible for delivering them. And we have this view that there is a sort of virtuous circle here, that actually if you have better governance of companies, then you get better quality reporting. And if you couple that with rigorous audit, then that gives the market confidence, and it gets engaged investors. And what we're trying to do here is create a system where everyone understands their role, where everyone really understands the part which is before them and can rely upon that. Now, you might say, well, what really is the overarching point of this? And the answer to that is it's about inward investment in the United Kingdom. It's about your pension and mine, all of which are largely invested in some of the largest companies listed on the London Stock Exchange. So we all need confidence in the numbers that people are reporting when they do their annual report and accounts. And that's what we're trying to do. And our role is to try and hold that system together. It's quite a complicated system, many interactions between it. So that's our role. To put it in a slightly different way, what we actually do is we regulate publicly listed companies. And so some of the areas that we're directly responsible for include the accounts, corporate reporting, and the UK Corporate Governance Code. We now own the UK Corporate Governance Code, generally regarded as the best in the world. It's the benchmark for other people to aim for. We also regulate institutional investors through the Stewardship Code. This is a code that sets out their responsibilities to steward properly the shares, if you like, that they own in our name. We also regulate then auditors, actuaries, and accountants through things like professional standards, the UK GAAP. We do international influencing to try and influence the international financial reporting standards, so that when they flow down into the UK, we've had some influence of those at a global level. And we are also the regulator of all of the relevant professional bodies. So many of you will be members or students of some of those bodies there. The ICAEW, I know the local 3 counties branch are involved in this. ACCA, I've put down the Institute for Actuaries because they're included in that, and SEMA and so on. So if you think about it, that's what we actually are regulating: companies, investors, people who are auditors, actuaries or accountants, and the relevant professional bodies for those people. So slightly bizarrely for me, because I'm a member of both SEMA and SIPFA, I actually regulate the body that regulates me. But there you go. And what does acting in the public interest means? Well, it means that we need to think much more about, not just about the parties that we regulate, but about the impact of those parties on other people. So we need to think through about what is the impact of the changes that we make, that we ask a company to implement, and what does that mean then on suppliers or employees or pension fund holders or customers and communities and so on. We need to think more broadly about what is that broad public interest. We broadly organize ourselves into 4 parts. It's relatively straightforward. It's setting standards, it's supervising the application of those standards, it's enforcing them where we need to, and then obviously you've got the running of an organization. So we divide ourselves into these 4 logical blocks. So in regulatory standards, for example, you've got there the people who set the UK audit policy. So we take the international audit standards, we add on some supplemental policies for the UK. Then we say this is the UK standard that you will have to reach. And then in supervision, what we do is go around and check the audits which take place. We do a quality review of those, as does the ICAEW. We do that in partnership with them. We generally do listed companies and they do unlisted companies. And that gives some assessment back to the audit firms about the quality of it. And in extreme cases where the audit quality is not high, then we would enforce. So that's the logical flow: set the standard, check that it's supervised, that it's actually taking place, and then enforce. I've got a couple of slides which probably set out the key things that we're known for. So this is probably the most high profile enforcement case that we had, where we did a review of the work of Deloitte as the auditors of autonomy. We found that an independent tribunal in the end found that the firm and 2 partners failed to act with integrity, objectivity, and professional skepticism. The report of the independent tribunal is available. It's more than 220 pages long. It's an interesting read for those of us who are into this. And there was a £21 million fine for Deloitte for the quality of their audit. So that's one end of the spectrum where we need to take action. We have approximately 50 or so cases of that on the go at any one time. And at the other end, we are there promoting best practice. And here are 4 examples of where we've done some work on best practice. Probably the one that we're most proud of here is the climate thematic. What we do in these areas is we go out, we look at what is best in class in terms of reporting by companies of the impact that they're making on the climate. And then we pull those best practice examples together. We write a report on that and we put it back into the market so that the market can learn one from another what's the best practice in those kinds of areas. I put down the William Hill example because it was our view in 2015 that the way in which William Hill described their accounting policies was the most engaging that we could find in the market at that point. And so we again promoted the fact that we thought that was best practice so that other people could learn one from another. This is generally undertaken by something called the FRC Lab, which has a fantastically high reputation. It produces about 6 or 7, best practice reports a year on a range of different topics. It's also available for people to lobby, and you can say, and we take some soundings from the market about what are the areas that they're interested in. So we enforce where necessary, but we also promote best practice. So why do we need to change then? Well, I think there are 3 main drivers for politicians. The first of those is the obvious area of corporate failure, and I just picked out 4 here on this slide, probably well-known examples to colleagues who are involved in this session. British Home Stores collapsing, 11,000 jobs lost. HP and autonomy I won't go into because there are obviously other legal cases and so on, but the example I was going to use was Carillion. So this is a chart of the market capitalization value of Carillion. Now, if you go back on the left-hand side, you've got on the scale on the right-hand side, you've got the market capitalization value. So you can see over there on the left, way back in 2015, the market cap for Carillion was £1.3 billion. And those shares are essentially largely owned by institutional investors who are holding them on behalf of pension funders, holders. So either people are in pension because they want the dividend or because they're investing your pension savings, right? And you can see the trend there. It's slowly going down till you got to March 2017 when there was flat pre-tax profits. And the chief executive fairly quickly after that said there was an encouraging start to the year. But then in July, there was this significant write-down of the value of contracts, fall in cash flow and revenues, and the dividend was suspended and the chief executive left. Now you can see then that the market cap, the value of the shares literally plummeted down that line. There were then a whole series of further announcements about the company, more profit warnings, deferral of banking covenants and so on, to the point when in 2018 the company stopped trading because it literally ran out of cash. First example of a FTSE 100 company that got to this situation for many, many years, I'm told, if not the only one. So this is an extraordinary journey where essentially all of that value, which was created over on the left-hand side, is completely lost in this process. And the collapse of Carillion led to significant job losses. There's the broader impact about the fact that they were halfway through building hospitals and so on and so forth. Now, this is something which politicians, both Lords and Commons, get very, very exercised. How exactly does this occur? And there are various parties who look into why does this occur. Our review of the audit of KPMG of Carillion is with KPMG to consider an 800-page analysis of their audit, and it makes a series of allegations for them to respond to, which we're waiting on. But the Insolvency Service also looking at how exactly did this occur. So really exercised here. Politicians are very, very exercised about what happens in corporate collapse. Second driver then is audit quality. As I said, we do these things called audit quality reviews. We go around, we do around 150 or so a year. And I extracted this from the Financial Times. You can see what it says for yourself. But last year we found that 35% of PwC's audits and 39% of KPMG's required improvements. Now, I've lumped together there the ones which require improvements and the ones which are totally unsatisfactory as far as we're concerned. you give them a grading of 1 through 4. And so those in category 3 and 4, they're amounting to 35 and 39% respectively. And that is not a situation which has developed suddenly. It's been a situation that's existed for many years and is broadly the same wherever you go in the world. Now, for those of you who are involved in companies outside those in listed capital markets, broadly you get pretty much the same numbers through the ICAEW's Quality Assurance Director Review. So if you've ever been subject to one of those, it's roughly 70-30 in terms of acceptable and requiring improvement. So the quality of external audit is generally regarded as not being acceptable, definitely needs to be improved. So that's the second driver. And then the third is what's generally called as aggressive accounting. And I realize I might now be slightly straying into some controversial territory, but I picked out this quote from Kenneth Lay, who was the chairman and the chief executive of Enron. So you'll be familiar with the fact that there are international financial reporting standards that apply in the UK. But at the highest level of running a major company, the accounting standards allow for some flexibility in terms of judgment. So to take a straightforward and easy example, you've got some debts. What's an appropriate provision for bad debts? Some judgment is required in that. If you're in the long-term contracting business, well, you need to make some judgment about how much value is accrued in this particular year for that contract, how much profit can be accrued in this year. And those require judgments. They're not straightforward issues, and they require you to have a set of accounting policies overseen by the audit committee. But it does allow for some degree, significant degree of discretion. And I give you a worked example from us in that we looked at a joint venture, 50-50% owned by 2 FTSE 100 companies. The joint venture got into some difficulty over a long-term contract, went into a dispute, asked for some additional revenue. One of the companies assumed they would get no additional revenue from this dispute, and the other company assumed it would get 100% of the revenue from this dispute. Both of those judgments are actually within the framework of the accounting policies of the company and within the accounting standards, but they don't both sit easily, do they? 1-0 and 100, the diametrically opposed views. Now, the 100% accrual would generally be regarded in the market as what's called aggressive accounting. Somebody has made a very assertive assessment about how much of revenue is going to come in, and that then obviously flows through the rest of the statements. So those are the three drivers for change to try and deal with all three. Now, the upshot of that was the government decided to have 3 independent reviews. The first of those was actually about the Financial Reporting Council itself, way back at the end of 2018, a year before I joined, and actually it was conducted by Sir John Kingman, the chairman of Legal and General, and he essentially recommended that the FRC was scrapped and replaced with a new regulator with significantly better powers. These are some of the quotes. Obviously, the one which resonates most with most commentators who knew the FRC then was that it was time to build a new house, that it fundamentally needed to be taken apart, rebuilt, given new powers, given a clear purpose, and significant additional capacity and capability needed to be put into the FRC to do the task that it needed to do. He made 83 recommendations for change. Most of those, 66, were about what the FRC did and how it did it. But he did make a series of other recommendations to the government that the UK should have a version of Sarbanes-Oxley, and I'll come back to that. I'm sure that most of you will be familiar with that regime in the US, but not currently in the UK, but he recommended the government considered it. A recommendation the government is very, very likely to accept, that actually our regulatory remit should be extended to very large companies, which itself is quite controversial. British Home Stores was not a listed company when it collapsed. It was in private hands, remember, and politicians are quite concerned about is the sort of cliff edge difference between being on a listed public market and those being in private hands. And what they wanted to do here was to try and rebalance that, so the accountability, if you're running a large private company, should be the same as if you're running a publicly listed company. So that was the first review. The second was by the Competition and Markets Authority. They looked at the state of the UK audit market. They recommended a series of quite powerful things. to start with, I think it's worth just saying something about they thought that audits were, a vital contributor to the trust and confidence that's required in a modern economy. That's probably the quote that I like the most. You know as well as I do, if somebody says the audit's fine, everyone should be able to rely on that. They pulled that out and emphasised that. But they thought the market exhibited a number of deep-seated problems. They didn't make very many recommendations in the end, 5. I just picked out a couple. The 2 which have the most resonance here are the fact that there should be a minimum standards for all audit committees in the UK. We do not have minimum standards for audit committees. You can actually find some, but there's no statutory backing to those. Some other countries in the world do have that, Sweden, for example. And the other one was that the audit function of the Big 4 should be split from the rest of the firm and put at some sort of arm's length, which is called the operational separation was the term that they used. So a couple of really huge recommendations for the government to consider. And then the last was by Sir Donald Brydon, the chairman of SAGE. He wrote a report which was, what is the point of an external audit, and called for sort of urgent review. This is, I think, my favourite quote from him is that at a time when information is everywhere, it matters even more that shareholders can trust what directors are communicating. So if you're an investor, you get your annual report and accounts, that's what the directors are telling you, and the auditors have the unique advantage in seeing, having the right to see everything and then opining upon what the directors are telling you as an investor. So he made a series of recommendations, 67 overall, but broadly spread across those players that I talked about in the system, 23 for the government, 19 for auditors, 22 for companies, and 3 in which he fundamentally questioned the scope of an external audit. And there was some resonance in the recommendations with the previous reviews, higher profile for audit committees, for example, new statements on risk and resilience, and much clearer language about communicating with people about the audit findings and the audit conclusions. So you might say, well, why did I take you through all of that? Well, the answer to that is that I want to really hammer home the point that in order to get some significant change in this area, this really shouldn't be called audit reform. Everyone calls it audit reform, but it's not really about audit reform. Actually, it requires all the major parties to improve. So you need more engaged investors, you need improved reporting and higher standards by companies, more consistent performance, I think, is really the answer there. It's not that there aren't high quality standards in many companies, it's just it's not consistent across the UK market. You definitely need higher quality audits, and you fundamentally need to rebuild the regulator. And if you put those 4 parties together, actually thinking about it in a whole systems approach way, you should get higher standards. So I've got only a few more slides to go, but what's the key impacts if you're a company? Well, as I said before, large private companies are brought within the scope, regulatory scope of the FRC. We currently have 1,777. The recommendations from government more than double that number. A UK version of Sarbanes-Oxley with board attestation about the state of internal control. Minimum standards for audit committees, as per some countries in the world, and then a series of new things about risk and resilience, the legality of dividends, what people have done on material fraud, and then thinking about a 3-year audit policy. Those are the key impacts on companies, not the only ones, but those are the big ones. Key impacts on auditors are new framework about resigning out of rotation. So there's some concern about what happens when an auditor resigns out of their rotation period, and largely when you talk to auditors, it's because they've got some concerns about the company, underpinning concerns about the company and the way it's run, or its governance, or a very dominant shareholder who also happens to be the chief exec and the chairman or something like that. But they very, very, very rarely say anything like that in public. So some new frameworks about being more transparent about why you're resigning. Clearer auditing reporting, this fantastic thing called graduated findings. So my third driver for change, this thing about aggressive accounting, actually could be brought to light by a fantastic piece of work that was done by KPMG, who actually tried to assess the aggressiveness or prudence of the accounting policies of companies. And they put this into a report called Graduated Findings, and we're expecting that to come through and be the industry norm. A couple of things which I already talked about before: shared audit, operational split, more emphasis on an obligation to work on material fraud and say something about whether there is any material fraud. And then the audit scope itself is extended beyond the accounts into some of the metrics in the front half of the annual report. So what alternative performance measures, KPIs, and so on. And then for us, well, we're abolished. So that was an interesting choice for me, wasn't it? Took on a job that needed fundamentally rebuild the organization, then we'd be abolished. But we'll be replaced by ARGA, new powers across a range of different things like competition and monitoring the firms and so on, reclaiming some functions from the ICAEW, new governance, new board. I'm the new CEO, and so on and so forth. So quite a lot for us to do to fundamentally rebuild our organization. So 2 more for me then. Well, what happens next? Well, the government needs to publish a consultation document, and I boldly assumed that by now we'd know when that was coming. So I put in date, thinking I'd type in that it had been published. Hasn't yet been published. Is ready to be published. So essentially what that document will do is to say we had 155 recommendations, here's what we're thinking about, and here's what we propose to do. And then there'll be a 4-month consultation period for people to write back to the government about those propositions. The government needs to consider those and then think about passing some legislation and creating ARGA. What we've assumed is that the new regulator comes in April 2023, and that these changes will follow after that. So my last slide is then a couple of other considerations to think about. First is to say we do not expect all of the changes that were recommended to be accepted. I do expect it to be more than 90%. But I do not believe that all those changes will drop all in one financial year in 23-24. We'll need to think very carefully about phasing some of these changes in. It is a pretty significant undertaking to introduce Sarbanes-Oxley. If you're not currently implementing, we can definitely learn from what the US did in the early 2000s. So it won't all happen in one go. Secondly, we will start with the largest companies. Several of the propositions which are in the consultation document say we will start the FTSE 350, review how that is implemented, and then we may move on to other companies in due course. The third consideration is what's this all going to cost? And it's fair to say this is not free. Both the Audit Committee minimum standards and SOX both have a net cost to the company concerned. And then the fourth thing is, how do you design really quite complicated systems change? Because if you actually do want to have all 4 parties implementing 155 recommendations for change over quite a compact period, there are bound to be some things that bump up one against the other that don't quite work, and then you have to reiterate a change program of this scale over some time. So those are some of the other considerations. Now that completes my presentation. Sorry, it took me a bit longer than I thought, 25 minutes. But I'm now very, very happy to turn back to colleagues and answer some of your questions.
Brilliant. Thank you very much, John. That was a really, really great summary of how things have progressed. And I think we were probably all hoping that we would have had the phase proposals by now, and we would have had probably a bit more meat to discuss on exactly what the future is going to look like. But we have got quite a few questions come in. So I'm going to start with one, and hopefully I can get it on the screen. No. Oh dear. That has not worked. So I was going to start with the first question there. I'm getting some advice privately saying, just say who. Okay. Sorry. That's the joys of using technology. So I was going to start with Fadi's question. I'll just work through them in order. I think that's probably the easiest thing to do. So Fadi is one of the lecturers at Lincoln, and he's asking, when you look at Carillion and you look at it as such a big governance failure, how might accounting and finance professionals be released from their conventional role to reclaim the profession in the public interest? He does have a follow-up question as well, so it might help to take both together, and hopefully it'll help, kind of bring together the conversation. So Carillion's failure has raised a call to revisit conceptualizations, so accountability, fairness, transparency, and stakeholders. So who is accountable and who are they accountable to?
Thanks, great questions. Great questions. I'll tell the second one first. I think I'm sorry. Would you mind muting, because I can hear myself back the other way? Sorry. Thanks. Well, so I think the first thing to say is, who are you? So I think the traditional model is that you're accountable only to the shareholders, and there is a sort of a deep-seated view that actually a company is accountable to its shareholders, and is it accountable to anyone else? And the answer to that is increasingly, for those who think much more broadly about a company, is you're not just accountable to the shareholders, you are accountable to a wide range of organizations. So if you take Thomas Cook, which was based in the place in Peterborough where I live, actually when it collapsed, you could feel that impact on society, on communities, on jobs, on pension fund holders, on a wide range of other parties. And the government's move there has been to introduce the so-called Section 172 statement, so that the board should say something more overtly about how it's working in the interest of all stakeholders, not just those who happen to own the company. The next logical step from that will be metrics around the impact of a company on the environment, on society, and its governance, its so-called ESG. Now, there are some really good emergent measures about impact of a company on the climate. We recommend TCFD as a framework, and we recommend the SASB metrics. You can adapt those SASB metrics depending on what's the nature of your business. Now, we think that's a good global standard. It's good enough to report in the front half, and on that basis, if you say, well, here's our financial statements, but actually here's some statements about the impact on the environment, then you're beginning to be much more accountable. And there's some fantastic best practice on this in the UK. So you're much more accountable to a whole range of companies the more that we put out this framework that says that you're accountable, you have to make more statements, you have to put more metrics in. Bryden then says, well, some of those metrics ought to both be standardized and audited. So that's the way forward in which you can force that accountability if companies are prepared to take it on. I think the vast majority are prepared to take it on, do invest in ESG metrics, and do think of themselves as being accountable beyond the shareholders. How do accounting and finance professionals sort of reclaim this? Well, some of it is in terms of trying to broaden out the board's perspective on its impact. And there are many people working in that, and the Chartered Governance Institute, I think, is a really good example of what used to be the Company Secretaries Association, now moved on more to say about governance and broadening out the way in which companies work. But I think the other thing which is really going to make a difference here, and I think would have made a difference in Carillion, is the rise of the importance of the Audit Committee. And the Bryden was deliberately trying to position the Audit Committee, as was Kingman, in sort of as a real counterweight against the board. And you certainly, FTSE 100 and 350 CEOs and chairs say to me, hang on a minute, there's these reforms could mean that you might have the chairman and the chief executive on one side of an equation, and the Audit Committee chairman and chief finance officer on the other side of an equation. This kind of internal organizational tension where some are trying to push forward results and others trying to say, hang on a minute, we might want to be more prudent in those areas where we've got some significant judgment. But I think what is absolutely clear is that the role of Audit Committee chair will significantly rise under these reforms, much more accountable, more transparent, and consequently, and to be upfront about it, having talked to 280 now of the 350, FTSE 350, they're all up for it. They all want to go for it. I mean, there are very, very few voices against that. So I think that's sort of a combination of answers for Fadi.
Brilliant, thank you. So I'll go to Nathan's question next. So Nathan's one of our third-year students. How do you think COVID has changed the way that the FRC work? And do you think the changes will last?
So there have been two significant changes. Obviously, I think for the majority of organisations, we've been working at home since last March. March the 18th was the last time anyone was significant was in the office. We'll celebrate the 1 year anniversary of that fairly shortly, and that has fundamentally meant we've had to rethink how we do work, how we engage with each other, how we engage with the people that we work with and regulate, and so on. And that is it's commonplace across the economy. What it will mean for us is very practical things like I was about to lease another floor of another building, won't be happening anymore. Revisit all of our working policies so that people have much more flexibility about where they work, when they work, how they work, and so on. So we used to have a hard and fast rule: if you couldn't work at home more than 1 day a week, I mean, forget that. That'll be long gone when we finish this. So all of that is good, and everything that goes with that in terms of technology and so on. And I'm sitting here with and this has been working like this for a year, and the technology's been brilliant. So all of that, I think, will become embedded. But I think the other great change has been actually it's significantly improved our engagement with stakeholders, because I'm doing this with you. I don't know how many people are on this call, but I've been doing calls with literally thousands of people. It was possible for me the other day to reach every single person who worked at PwC's audit function all in one go, 5,000 people for an hour. That wouldn't have happened before. It wouldn't. So that I think our engagement with the people who we need to give us views about these changes has significantly increased. So those are definitely two changes that will stay with us.
And I think those are really positive things. And in a similar way to how the university's working, we're seeing more engagement with more people with events like this. So it kind of works across the board. If I go to the next question, I think it's saying, large companies, will this be based on the current size limits, or do you think that we might change them? I mean, I guess at that point it might be worth thinking about pies and what might come into being a pie, or whether there's anything more interesting that you expect there.
Yeah, thanks. So this does revolve around the technical definition of what is a public interest entity. For those of you familiar with this, and I'm sure that some of you will. So at the minute, we only regulate public interest entities as defined in law. And the vast majority of those are publicly listed on the London Stock Exchange. But the proposition is to significantly extend that through, as I said, large private companies. The definition of large is set out in the Waits Corporate Governance Code for Private Companies, led by Sir James Waits of the Waits Construction Group. And he recommended to the government that the definition of large was turnover, market capitalization, and balance sheet based, and number of employees. So it's a combination of those three things. So off the top of my head, it's a turnover of more than £200 million, or more than 2,000 employees, or a balance sheet gross value of more than 2 billion. Now he actually did the research when he produced the Waits Corporate Governance Code for Private Companies, and actually worked out there are roughly 2,066 is the number from memory, companies that would meet that definition. And actually the drift has been slightly away from being publicly listed into being privately owned under those definitions. And the thinking here is to, if you like, there's a set of regulatory standards if you're publicly listed, and there's a set of regulatory standards if you're privately owned. And the answer is to bring up the private standards for the large companies. And the case studies for this would be, for example, British Home Stores, where there's very little accountability for the board of British Home Stores. So that's what it's currently based on. Actually, the consultation document, it will have some other ideas in it too. So there's a very open question that says, should the government include NHS trusts, local authorities, and universities? Because if you think about that question about public interest, what's the public interest? Actually, most of those three groups are large employers, have a significant impact upon a local economy. Are they well run? Are they telling people transparently, how they're spending their money, and so on and so forth. So, but the question is very, very neutral. It says, we think there might be a case, but what do people think? Oh, and charities too. Charities with a turnover of more than 200 million. And there are quite a few of those UK-based too. So it's a very neutral question. So we might see it expand even more. I'm not sure any of those will come, but I do think large private companies will come within the definition of a public interest entity.
Brilliant. I've got a question now from Jade, one of our students. Do you still think that audit is a good profession to enter? And are the challenges for junior auditors getting just a little bit too hard?
Oh, I totally would recommend it. I mean, I did work for E&Y for 5 years. It was a fantastically interesting thing to do. You learn so much because you move around different organizations. You see different approaches to similar kinds of problems. You learn a huge amount about yourself, about them, about what you can do. So now in my case, as is the case for most people who work for a firm of auditors, you do audit to a certain length and then you spin out and actually go and work for one of the organizations that you might have audited or similar to that you audited. And it is a fantastically interesting thing to do. Is it more difficult? I don't think it is necessarily more difficult until you get to the point where you're the partner, because essentially you are, if you use my aggressive accounting example, the CFO and the audit committee have decided to adopt a particular approach to accounting for something. It's really only the partner that can go into that room, challenge that, provide some professional skepticism against that, sure, fed by the team, but you have to wrestle with that to some degree. But in the end, it's the partner, particularly because they now have to sign the audit report with their actual name. So the accountability is absolutely with them. So I think what I'm told by some of the big firms is people will linger over whether they want to be a partner or not. But the profession itself, I think, is fantastically attractive, and I would totally recommend it for anyone.
Yes, and I think I would agree with that too. When I'm teaching audit, I still recommend that students do enter as a profession, although I think the landscape's very different than when I was doing it, and possibly than when you were originally doing it as well. So a question from Lucy, what should listed companies be doing to prepare for these changes before the new legislation? I mean, is there anything that they can do to get ready for it?
Yeah, there's plenty that they can do for it, and to be upfront about it, many of them are plugged into us. They know what the reviews said, so switched on audit committee chairs, for example, will know exactly what Kingman said and what Bryden said. They've had a decent steer from us about which of these recommendations are likely to go through. So many of them are preparing. We work very closely with a forum called the Audit Committee Chairs Forum, which is the FTSE 350, the Audit Committee Chairs club together. They have a group that engages with us. They have an executive. And actually, some of the government's thinking was stimulated by papers that they wrote. So anyone who's a member of the ACCIF and it is profiled in Bryden, recommended by Bryden that it had more profile, they'll all be preparing, thinking about what is the role of the audit committee, how does it do it, what are the new accounting standards, what might be the new reporting requirements, how might they introduce Sarbanes-Oxley, and so on. There are about 50 companies listed on the UK market that are also dual listed in the US who are already within the scope of Sarbanes-Oxley. Some of those are already beginning to share their experience with companies who would be within scope to that family of audit committee chairs and CFOs sponsored by the 100 Group are all now talking very, very actively, because they know that pretty much everything I've said there is all coming their way. It is my intention, because we did this in my previous organizations, that as far as we possibly can, we will co-create the changes with the relevant organizations or representatives thereof, because I think it's much better if we could say, well, here's a draft, what does that look like, stimulate a whole series of webinars and seminars and so on, and then say in the end, well, you created it. So the first paper that was ever done on could you introduce Sarbanes-Oxley in the UK was actually written by the audit committee chair of Santander. So he wrote how you could do it. That was a great genesis of a conversation. That conversation's now got more people involved in it, and that's the way we'll do it. So I think the FTSE 350 for sure, premium listed probably. Beyond that, I don't think they particularly need to do anything at the minute, because most of this probably isn't coming their way for 3 years at least.
Brilliant, thank you. I'm going to take two questions together now. So the next one is going to be from Ian Phillips, and I'm going to sort of take it with the question from Ian Robinson. So Ian Phillips has said, how can family-owned company audit requirements fit within a framework that is designed for the PLC market? And then we've got a question from Ian Robinson, which is, what are the implications from all of this for smaller companies? And I think those questions fit quite nicely together, so that's why I'm going to put them together this time. So what are
yeah, no problem.
yeah.
So it depends. So we could have a very long conversation about what's small. But I'll get to that in a second. So for family-owned companies, it depends how big it is, but let's presume that it's not big enough to meet my large private companies definition. Then the answer is, at the minute, nothing particularly. You don't have to worry about it. What will happen in the listed market will eventually flow down into the other markets in a very much more straightforward way, but I would not expect you to see any significant change to family-owned company audit requirements for some considerable time. If you think ARGA comes in 23 and we introduce some changes in 23, 24 and 25, by the time that then works its way through other tiers and other standards, status and so on, you know, you're looking at this being the mid-2020s and maybe a bit further than that, and whatever it would be, a very significantly watered down version of everything I've said. And then in relation to small, same answer, apart from there is a very significant debate about what is small. So one of the challenges that we have here is there is a general view that if you're a public interest entity, in other words, you sell equity on a London market, you're inside the scope. Now, you've got GlaxoSmithKline at one end of the market at 130 billion, and the smallest listed company actually has a market cap under 20 million pounds. Now, you know, is it reasonable to say they both have to fit within the same framework? And the answer to that is almost certainly no. And therefore, some threshold will eventually be drawn on the market. Now, there is a great a lobbying organisation called the Quoted Companies Alliance that lobbies for small companies that wants it to be 1 billion. Now, I don't think anyone would think 1 billion market capitalisation is small. That's my personal view. I think when most people talk about small, they really genuinely mean, you know, hundreds of thousands, low millions turnover. They don't mean 1 billion. The other point of reference here is that the EU is seriously considering a small company as being under €1 billion market cap. Now, that is a pretty significant threshold. I just don't think our politicians will go for that. I really, really don't think parliamentarians will think £1 billion is under that is a small company. I don't think for the general public that's a small company either. So a debate for another day, but I don't think at the minute anyone should worry about how is it going to land on them anytime soon.
Okay, brilliant, thank you. So Matt's question is, what do we expect to be the most impactful change of the scope of ARGA or the FRC on improving quality and transparency of corporate reporting?
Well, one of the things which Kingman pointed out was we do 150 audit quality reviews and we do 300 corporate reporting reviews, none of which is published. And he directly compared and contrasted that with, you know, Ofsted reports on schools, which is, you know, I think is fair. So I think the biggest thing which would have an impact on the transparency and quality of corporate reporting is if our reports were published. So we do 300 a year out of the 1,700. We try to get round every single one of them in once every 5 years or thereabouts. If we actually said, you know, here's what we think about the annual report of, you know, company X, Y, or Z, I think that would drive significant additional accountability. One of the cores of this reform is trying to make as many of these changes land on one person. So there's a personal accountability. It's the audit committee chair, or it's the CFO, or it's the audit partner, or it's me. If you drive personal accountability, then you're much, much more likely to get sustained change. And that's certainly a lesson that we can see from the US. So publishing it flowing into the public arena, Mark Kleiman says FRC thinks report of XYZ PLC wasn't any good. It drives a certain amount of behaviour. So that level of public accountability, I think, would be the biggest thing we could ever do. If I could move to that now, I would. We can't because we don't have the powers to do it, but I think that would be the biggest thing.
Great, thank you for that. So I've got a question here on whether or not you think forensic accounting should be an integral part of the audit function as a way of mitigating accounting excesses and misstatements.
No, I think, well, let's say no. I think a much higher priority will be that the firms will move to whole systems transactions review. So most of you, I guess most colleagues on this will be familiar with the idea of sampling. You take, X transactions out of a population of Y. That, I think, is something which will stop. I don't think that will last more than a few more years before actually technology is available for the auditor to take all the transactions out of a system, run them through various algorithms, and say, I've looked at 50,000 transactions. It's those three that we need to have a look at, or here's some patterns or whatever. And the big four are spending literally billions of dollars on technology, on automation, on AI, and on this whole systems approach. And I went through a demo with one of them a couple of weeks back, where they are now piloting in the UK 200 audits, where they will go through. Essentially, what happens is they take the entire finance system, a copy of it, out, and run it through all of these changes. Now, that I think is going to be really, really interesting to see where that takes us. It's not, rather than a random sample, it's like, look, we can pick out these transactions we think they're odd. Now let's go and sample those. Now, I think that will be a huge step forward in terms of the way of thinking about that. Now, there is a place for forensic accounting. I'm a great fan of it. We employ forensic accountants. If anyone wants a job, by the way, drop me an email. I can never get enough. There's tremendous demand for forensic accountants in the UK market. There aren't really enough. They do some fantastically interesting work. There are some specialist firms who do it, like Alvarez and Marcel. We use forensic accountants to go back through audits which we think are very poor. So the Deloitte's case, the autonomy case, was put together by a team, half of whom were lawyers and the other half were forensic accountants. They put together the 800-page assessment of the audit of autonomy by Deloitte. And that's the way that we work. So it's a great profession, great discipline to be in. I would totally recommend it if you want to go down that route. But don't expect that you're going to be involved in very many audits. There'll be some other very, very interesting things that you'll get involved with.
Perfect, thank you. I am a bit conscious that we are running out of time, and there's quite a lot of questions. They've started coming in thick and fast. I think this one might be quite a quick one. Amina is one of our master's students, and she's asking, do you believe that non-financial metrics can be effectively audited if the review comes to form a part of future audit?
So the straightforward answer to Amin's question is yes, providing we're clear about what the standard is. So I earlier referred to SASB. That is a reasonably mature framework. You can pick which kind of it measures the impact of your company on the climate, on the environment. But you could say, there's a difference between being a retailer and being a minerals extractor, for example. So you define what kind of company you are, and gives you a series of standard metrics that are used everywhere the framework is used. They're defined. It's a good standard. Those can be audited. So yes, straightforward question, as long as the standard is good enough. And that is where globally there is not an IFRS for non-financial reporting, and one will need to develop for these kind of metrics in due course. But meanwhile, SASB is good enough on the environment and climate.
Perfect, thank you. So the next question I think I'm going to go to is from Chris. Directors publish the accounts for shareholders, which I think has always been the historic view. So should the FRC or ARGA have more power over the board of directors as a whole, rather than the audit committee members, and rather than BAEs?
So great question, Chris, and the answer to that is yes. At the minute, our regulatory remit is only over those members of the board who happen to be qualified accountants. And there are many CFOs in large companies who aren't qualified accountants. So it's perfectly possible that a company could collapse and we can't take any regulatory action at all against anyone who works in the company, because neither the CEO or the CFO are qualified. Now, the proposition from Kingman is that everyone on the board should be within the regulatory scope of the FRC, or ARGA, and that proposition will be accepted. I'd be stunned if it wasn't, because the Companies Act says it's a unitary board. They're all responsible, and the powers of ARGA will be brought in line with the Companies Act, so that we could take action against all members of the board if we thought they were all not carrying out their duties. So yes, it's a straightforward answer to that question.
Brilliant. Have we got time for another couple of questions, do you think? We are,
sure.
So I think we might go slightly over time if we try and do this, but Steve's asking, do you see the need for greater regulatory oversight of institutional investors? I assume that's Sir Donald Bryden. When last Steve spoke to him, that was on his agenda.
Yes, is the answer to that question. So if you talk to the chairman of listed companies, they will tell you that broadly shareholders are about 80-20, not engaged. And the ones who are engaged are very, very focused on remuneration and profits, but not much else. So we've got this big slug of institutional investors who aren't really engaged, and many of them will vote on the basis of what proxy advisors say. In terms of resolutions, that there's an industry of proxy advisors who say, vote this way on these resolutions, and people will just automatically do it. That is incredibly lazy. Is to be frank about it. There are some brilliant market leaders here who don't do that. That means they have to put time and resource and people to look at the companies that they're investing your pension and mine in before they decide how they're going to vote. And the idea is that we would get more regulatory oversight of that, starting with the Stewardship Code, which has raised the bar. It will now become a benchmark, I think, in the end for people who want to invest their pension is, are you or are you not signed up to the highest tier of the Stewardship Code under the FRCC or any good at that? I think in the end that will be the ultimate answer to that. So yes, the way forward is the Stewardship Code, and then we'll go beyond that.
Brilliant. And then I'm kind of thinking as a last question, we'll do a little bit of a multifaceted question that hopefully answers some of the remaining questions that are there. I can see I have a question from Phil. And Phil, I taught about 5 years ago, so it's nice to see you've got some alumni back on the call as well. So he's asking about whether quality is going to kind of deteriorate effectively with the amount of paperwork. So is it sort of making the audit function move away from recovery? And I am going to put it together with two other questions. They're not really strictly related, but I'm trying to kind of end this and get as many questions answered as quickly as possible. So Ian's asking about whether or not we can actually, how the Big Four can actually develop this whole population audit. And I think that probably fits with the paperwork. So the amount of work that needs to be done for compliance, whether or not, anybody who's working outside that can actually, how they can effectively deal with that. And the final one is from one of our students, Matt. Do you think the Big Four have too much power? So will they resist the change in the regulations? So sort of, what is, as I said, they're not really related questions. I'm just trying to get in as many as possible at this point, so that people have a chance to speak. So effectively, if we can try and deal with those largely unrelated areas.
That's fine. So the answer to the first two questions is outside the Big Four invest in billions because of the global network, but I think the next 3 to 7 will develop their own methodologies further on their own. Beyond that, there are companies working on technological offers to auditors, to smaller auditors, and I've engaged with a couple of those. So they're using open source material, Microsoft based. There's one that's done a formal partnership with Microsoft, and is developing a sort of audit methodology package which will do whole systems transactions. And it's emergent, is probably the best way of putting it out at the minute, but they're out there testing it with some smaller auditors. So in the end, there'll be a market offering, I think, for smaller firms of auditors, and I think that'll be a good thing to engage with, which will deal with hopefully with both the paperwork and the sort of outside the Big Four, which I've sort of expanded. So that I think will be in the end will be the answer. The same as it was for Making Tax Digital for Business. The market rose to Making Tax Digital for Business, and stimulated by HMRC, provided a range of different software options, and many people took them up. And you probably see the adverts on TV for Sage and all of that. That's the answer to the you can't afford to do it yourself. The market provides it. and we will stimulate that. Do I think the Big Four have too much power? What a great question to finish on. Of course, it wouldn't be right for me to say whether they do or they don't, but I can tell you this: they will not be able to stop these reforms happening. In my opinion, they are very, very engaged in these reforms. They've been, to be fair, really good at operational separation, which we've done on a voluntary basis. The Big Four are all putting their audit practices at arm's length, hiring independent chairs, non-executive boards, different sorts of metrics, full transparency on P&L for us, and all the things that we published in our 22 principles. They're all pretty much following that. They didn't have to do that. They could have easily said no, but they aren't. They're all engaging very heavily in it. I don't think they have too much power. I think they are respectful of the situation and of what parliamentarians want, and the fact that the regulator will have a lot more power. So they're engaging very, very well. I don't think so. No, I think is the answer probably in the end.
Brilliant. Thank you very much for answering so many questions. And I am really sorry to those people who I didn't quite get to their question. But as I say, near the end, they all started coming in thick and fast. So thank you very much for that. I think Craig is going to come back on. Oh, there he is. Excellent.
As if by magic. Thank you. Well, how fascinating was that? And I can't believe we just spent an hour on that. And so, Catriona, well done for handling so many questions. Jon, I think just the nature of the questions showed just how much interest there was in what you were saying. So, thank you so much. As a non-professional, I found that really insightful in terms of both insights into the profession, but also into the regulation of and governance. And I'd never appreciated just how much was involved actually in the work that you do at what is currently FRC and is about to become ARGA. So, Jon, it just remains for me to thank you so much for your time this evening, for having such an interesting and engaging way of presenting such a fascinating topic. And I do hope that actually you've inspired some of our students to take up this as a profession. I'm sure they've noted your email address in terms of forensic accounting, and that I think in a sense is obviously our key purpose this evening, which is inspiring others to come into the profession. And you've absolutely done that for us. So, Jon, on behalf of the University of Lincoln and the Lincoln International Business School, thank you for such a fascinating talk.
Thank you.
Thank you. And good evening to everybody. Thank you. Thanks, Catriona.